who stands to lose and pay the price for this, for the fact that the Fed, or for your idea that the Fed has no catalyst to cut rates and that they'll be higher for longer? Who in your opinion is positioned to lose the most here?
I think it's got to be focused on the bondholders. People who are buying bonds today, and I thought today was actually a really interesting example because you saw this intermarket action dynamic that was happening, which is that stocks started to fall and bonds were bid hard in response to stocks falling, without much recognition, without an acknowledgement that like bond yields have already fallen a ton. Right, it's a 1% or 1.5% move in stocks just off of all-time highs, right, in a total return basis, is creating a huge bid on bonds. That set of linkages doesn't add up. I mean, it adds up directionally. Like in general, when stocks go down, bonds often go up. But what doesn't make sense is the magnitudes and the order of magnitudes between things. And so basically, we've got a situation priced in the bond market where huge cuts are expected, no inflation, and recession that's priced in. And it just, it feels a lot like conversations I was having, a year ago when I was like, look, the economy, I think, is going to be a little more resilient than people expect. And people are like, you're an idiot, buy bonds, 3.5. They're going to 3, they're going to 2. People were hollering about how bonds were the best buy in the world a year ago, and they were dead wrong by a lot. And only, really bailed out here in the last minute by the Fed and Treasury easing. And so I think we're like getting back to that same situation. That's why I go back to that headline story, which is the macroeconomy itself is not moving. It is boring. It is meandering very, very slowly, moderating a little bit. And our expectations are going like this. And the expectations today in the bond market are for no inflation, fast interest rate cuts, and a terrible growth outcome in 2024. And it just doesn't make sense.